All right, welcome back. We're watching the U.S. 30-year long bond yield following a big auction this afternoon. Rick Santelli, not at the CME Group in Chicago, right here in Englewood Cliffs, New Jersey at CNBC HQ, is here with the bond report. Now, let's get to the 30-year first because it is the news of the afternoon. The grade that you have, and it was still pretty good.
Yes. Yesterday was an A-plus 10-year auction. The amount of leftovers that the dealer community ended up with was a historic low. It was years since we've been at those percentages. However, today it was 10%, which means investors took 90%. And that's really aggressive, especially on a 30-year, especially on a reopening. And it underscores what the demand is for long-dated treasuries in the U.S., despite our deficits, despite our debt, despite the fact that politicians on both sides of the aisle don't seem to be aware of how these debt and deficit numbers aren't improving much. Having said all that, France is worse, okay? The UK is worse. So our G7 compadres, they have to issue as well. And investors are showing up at our auctions lately in a much more aggressive fashion than they had been. And I think that's a really good sign at a time where we need demand at our auctions.
So it's interesting. You mentioned the demand in a historic level in terms of the dealer takedown for that 10-year auction yesterday.
Right, smaller the better.
The smaller the better. It means the dealers didn't have to really do anything.
Exactly.
Everybody else took the offering.
And you'll never have a failed auction.
Now,
the dealers always have to step up.
They have to. That's the point of being a primary dealer.
Exactly.
You have to participate in these auctions. The question I have is something along the lines of what you said. There is demand out there for our long-dated debt. Dealers are not having to take down as much of these offerings as they have historically in the past. There is still a lot of bidding for every bonded auction out there. All of this, as we hear Megan Casella telling us about $1.1 trillion in interest paid on the debt that we have so far. At some point, these things have to kind of maybe come to a bit of a head, do they not?
They do, and to make it matters even more incongruent, I still think equities have some runway. So let's frame this out. We have historic amount of servicing the debt, taking a big chunk of money out of the economy, right? Could be going to other places that are much more efficient. And while that's going on, we still see records. The Dow's just cooking in grease today. So I think that there's aspects of the economy that are good, but I do think there is a reckoning. I think the notion of coupon clippers down the road, all those older Americans that have watched their 401ks skyrocket and they're going out. When you go out to restaurants, Dom, what's the majority of the patrons? Restaurants I go to, it's slightly older Americans. They have some money, they're spending it, and their 401ks are juicy, but they better be careful because if you're too aggressive and you're 90-10 or 95-10 in terms of equities to fixed income or debt, you need to start getting back to some normal levels while the taking is still good, while equities are still good. You need to slowly make that transition.
All right, so